Welcome to the Deep Dive. We're digging into your source material today, the DIY Investor's Ritley Market Compass, August 2025.
That's right.
Our goal here is, well, to sift through everything and pull out the really important bits, the insights you need from this latest update, so you can stay informed without getting, buried in data.
Exactly. Cut through the noise.
Yeah. And this week, the big question feels like, is this market bounce we saw the real deal?
Yeah.
Or just maybe a temporary thing, fueled by headlines, maybe some political drama? We need to look at the data, see where the strength is, and where things might still be shaky.
Good way to frame it.
So, okay, let's set the scene. This is for the week ending August 10th. Markets did seem to find their feet after a tough few weeks. We saw strong tech rallies, some earnings surprises, bond yields pulled back a bit.
Which helps stocks generally.
But it wasn't exactly a quiet week, was it?
No, definitely not.
Tariffs kept popping up, there were some big political moves, and the economic data was, well, a bit soft in places. Kept traders guessing.
And it's really crucial, I think, to see how all these different pieces connect. The tariffs, the Fed expectations, the company earnings. They all influence each other.
Absolutely.
Especially with how fast things seem to be moving this month in August. So this deep dive, we're not just saying what happened, but trying to get at why it matters for, your picture of the market landscape.
Okay, perfect. Let's jump into those headline numbers then. The S&P 500, it gained 2.4% for the week.
Solid rebound.
The Dow, the DJIA, up 1.3%, respectable.
Yep.
And the Nasdaq, well, it really surged, added 3.9%.
Wow, almost 4%. That's significant. Tech leading the way there.
Seems like it. U.S. stocks bounced back from their worst week since, early May? And yeah, like you said, the S&P and especially the Nasdaq got a big boost from some positive earnings, particularly a few mega-cap names.
Right. And connecting that, Treasury yields, they mostly stayed near their monthly lows, especially after that disappointing July jobs report came out earlier.
We'll get to that report in a bit. It's key.
But yields did start to creep up a bit by Friday. And remember, that means bond prices were softening slightly since they move inversely.
Good reminder.
And speaking of prices moving, crude oil actually went down this week.
Oh, interesting. Why was that?
Well, a few things feeding into it. Concerns about global growth slowing down, maybe hitting demand. Also, OPEC, plus increasing supply.
Okay.
And then there were those reports, you might have seen them, about former President Trump and President Putin possibly negotiating some kind of Ukraine peace deal.
Okay.
That tends to make oil prices dip on reduced geopolitical risk premium.
Right. Geopolitics definitely playing a role. But it wasn't just international stuff making waves, was it? Domestically, there was that political shakeup.
Ah, yes.
The source mentions President Trump firing the head of the Bureau of Labor Statistics, the BLS chief, accusing the agency of releasing, quote, rigged jobs data.
Yeah, that certainly got a lot of attention. And look, setting aside the politics, when a high-level figure questions the integrity of official data like that...
Data the market relies on.
Exactly. Data the markets rely heavily upon. It inevitably raises questions about data integrity, about trust. Maybe it's short-term noise, but it can create uncertainty,
Right.
Make investors wonder about future reports. It definitely sparked discussion about confidence in official stats.
Yeah, that point about data integrity feels really important.
Yeah.
And beyond that, tariffs were another recurring issue, right? You heard it on lots of earnings calls.
Oh, constantly. Lots of companies warning they might have to raise prices down the line because of these tariffs.
And internationally, the Bank of England cut rates, but the signal wasn't quite what the market maybe expected.
Right. They signaled, as the source put it, less dovishness, basically hinting they might not cut rates as aggressively going forward as people thought.
And that actually boosted the British pound.
It did, yeah. A bit counterintuitive maybe, but the currency strengthened on the idea that rates wouldn't fall as much as anticipated.
Okay, so let's shift to the broader economy and what the Fed's watching. That July jobs report we mentioned.
The big one for the week, really.
It came in weaker than expected, and that immediately fueled bets on a Fed rate cut in September.
Absolutely. It shifted expectations quite a bit, putting a September cut more firmly on the table, at least in the market's mind.
This feels like a really critical point for where the Fed might go next.
It is, although there were other signals too. The ISM Services report for July, it just barely stayed in expansion territory. So growth slowing there.
But there's always a but, isn't there?
Usually. The prices paid part of that report actually ticked up.
So inflation pressures still bubbling underneath, even with slower growth.
Precisely. And that's the kind of detail inflation watchers and the Fed will be zooming in on, that subtle upward pressure on prices.
Gotcha.
On the other hand, the good news, preliminary Q2 productivity numbers actually beat expectations.
Okay, that's positive. Why does that matter so much?
Well, it's welcome news when labor costs are still pretty high. If workers are more productive, it can help businesses absorb those higher wages without necessarily having to pass it all on as price increases. It helps offset inflation pressure, potentially.
Makes sense.
And as you said earlier, bond yields stayed pretty low after the jobs data, but they did tick up by the end of the week. That happened even though the 10-year and 30-year Treasury auctions weren't exactly blockbusters. Didn't see overwhelming demand there.
Interesting mix of signals then. So how did this all play out for individual companies? Any big winners or losers jumping out from the source?
Oh, yeah, definitely.
Apple had a massive week, right? Best in 5 years.
Incredible week for Apple, partly driven by that huge $100 billion U.S. investment plan they announced.
And they got another tariff exemption, too.
Exactly. Both big positives for them. Then you had Palantir, PLTR,
Right.
shares soared.
Why was that? The AI story is still strong.
Very strong. It seems like adoption of their AI tools is really picking up speed, both with companies and government clients. Huge demand.
Okay, so winners there. What about the other side?
Well, Supermicro, 7MCI, took a tumble. Their Q1 guidance just didn't live up to the, frankly, very high expectations the street had.
Expectations game. Tough one.
It is. And the trade desk, TTD, also slid. Seems like there's growing uncertainty about future growth there, maybe because of rising competition in AI-driven advertising.
So even within tech and AI, you're seeing divergence.
Definitely. Not a monolithic story.
What about the consumer? Any clues from earnings there?
Some interesting signals. Disney, DSEA, apparently reported no signs of consumer weakness. And that optimism was kind of echoed by hotels, travel companies, cruise lines.
So spending on experiences is holding up.
Seems like it, yeah. People still want to travel, go to parks. But then you look at McDonald's, MCD, and Wendy's, they showed more mixed signals.
How so?
It points towards more intense competition based on value. Suggests maybe consumers are still spending on the big trips, but for everyday stuff, they're watching their wallets more closely, looking for deals.
That makes sense. Any other consumer names?
Crocs, CROX, and Under Armour, UA, both warned about having to raise prices and also signaled it's going to be a kind of a long road for their turnaround efforts. So pressure on margins, maybe some consumer pushback on higher prices too.
Okay. And quickly, the global trade picture. You mentioned tariffs.
Right. Companies like Caterpillar, CAT, Maersk, they reported pretty healthy sales, which is good, but yeah, always overshadowed by those tariff risks. And Expeditors International, the logistics company, their comment was that global shipping is still volatile.
So uncertainty is still the word there.
Pretty much sums it up for global trade flows, yes.
Yeah.
Volatile and uncertain.
Okay, let's pivot and look ahead. The coming week, August 11th to 15th. Sounds like a big one for data.
Oh, absolutely packed, especially for inflation data.
Tuesday, 8:30 a.m. Eastern. CPI, the Consumer Price Index for July, and core CPI, stripping out food and energy.
Huge. Everyone will be watching that for clues on inflation's direction and what it means for the Fed.
Then Thursday, same time, 8:30 a.m. Eastern, PPI, the Producer Price Index, also for July, and the usual weekly jobless claims data.
Right. PPI gives you a look at inflation pressures earlier in the pipeline.
And Friday looks jammed. Retail sales at 8:30 a.m. Then at 10 a.m., we get both the Michigan Consumer Sentiment reading.
And expectations.
And expectations, right. And also the Atlanta Fed's Q3 GDP Now update, that real-time GDP growth estimate.
Yeah, Friday is going to be busy digesting all of that. A lot of info on the consumer and overall growth pace.
Beyond the data dumps, any Fed speakers we should listen for?
Yes, several. We've got Richmond Fed President Thomas Barkin speaking Tuesday and Thursday, Chicago Fed President Charles Goolsbee on Wednesday, and Atlanta Fed President Raphael Bostic also on Wednesday.
And their comments could definitely move markets, right?
Yeah.
Especially regarding that potential September rate cut.
For sure. Traders will be parsing every word, looking for hints about the FOMC meeting on September 17th.
Okay. And for those tracking individual stocks, earnings season isn't quite over. Any notable releases coming up?
Yeah, quite a few listed in the source. You've got Monday.com, MNDY, AMC Entertainment, AMC, Plug Power, PLU, Kava, Cavier, H&R Block, HRB, JD.com, JD, JD.com, JD, Cisco, CRCO, Applied Materials, AMAT, New Holdings, and others too. So still plenty of company-specific news.
Got it. Now, the editor's note in the Market Compass source, it seemed a bit cautious for the week ahead.
It did. It really highlighted that with CPI and PPI coming, plus that China trade deadline looming, the market could really break either way. It's sitting at a potential inflection point.
And the recommendation was?
Essentially, consider maybe staying on the sidelines for a bit. Let the data and the headlines come out. Let them set the tone before making big commitments. A wait-and-see approach, perhaps.
Makes sense given the event risk. What about specific levels the source is watching for the S&P 500?
Okay, for the SPX, the source flags next resistance levels at $6,125 and then $6,185. On the downside, support is seen at $6,130 and below that, $5,885.
And the overall weekly sentiment?
Listed as mixed, which reflects that uncertainty, that potential to break either way.
Okay. How about the U.S. dollar index, the DXY?
For the DXY, next resistance is pegged at $100.15, support down at $97.50, and the sentiment there is noted as oversold.
Oversold, meaning it might be due for a bounce. Or does the inflation outlook play in?
Well, the source note connects it to inflation. It suggests that if the inflation data comes in soft, really dives down, that would likely strengthen the case for a Fed rate cut.
Which usually weakens the dollar.
Exactly. So a soft CPI could push the DXY further down, testing that support. Conversely, hot inflation could give the dollar a boost off these oversold levels.
Got it. And the put-to-call ratio, that seemed quite volatile in the source's tracking.
It really was. The trend listed went from 1.53 down to 1.48, then jumped to 1.65, back to 1.51, and then a big spike to 1.93 at the end of the week.
Wow. Can you quickly unpack what that might mean? A higher ratio generally means.
Right. A higher put-to-call ratio generally means more puts, bets against the market or hedges, are being traded relative to calls, bets on the market. So that spike up to 1.93 suggests a significant increase in bearish sentiment or hedging activity right at the week's close. People getting cautious or protecting positions ahead of the CPI data, perhaps.
Okay, interesting. And the fear and greed index, where did that land?
That actually climbed, moved up to 59, which is in the greed territory, up from a neutral 50 the previous week.
So put-to-call ratio spiking suggests caution, but fear and greed moving into greed suggests less fear. How do we square that?
Yeah, it's a bit contradictory, isn't it? But the analyst's note from Baya in the source offers a take on the fear and greed index.
What's her interpretation?
She suggests this climb to 59 means the market has sort of reset its appetite after the previous pullback. It's maybe ready for more greed, more upward movement, unless some unexpected event throws a wrench in the works. She uses that phrase, saying the market's positive momentum, the groovy train will keep chugling along, similar to how it behaved last October. It implies underlying positive sentiment might still be there, despite the hedging seen in the put-call ratio. Maybe the hedging is just short-term protection.
Keep juggling along. Got it. What about Bitcoin?
Bitcoin BTC held support around the 112K level, according to the source, and managed to bounce.
And the outlook there?
The idea presented is that if the dollar weakens further, maybe on soft inflation data, Bitcoin could get a lift and start pushing towards the 125K resistance level again.
So key levels are 125K resistance and support at 112K and then lower at 95K.
That's what the source lays out, yes.
Okay. Lastly, the source usually includes a few specific stock ideas for consideration. What did they highlight this time? And just to remind everyone, these are examples from the source material, not advice from us.
Right, standard disclaimer. Okay, first one is ARM, ARM Holdings, ticker ARM. They're in microprocessor licensing, R&D, big AI angle there too.
And the suggested levels.
The source suggests looking to buy near $137.25 with the potential sell target around $142.25 and a stop loss at $132.25.
Okay, ARM. What's next?
Next is ASO. That's Academy Sports and Outdoors, retailer for sporting goods, outdoor gear.
Levels for ASO.
Buy suggested near $47.50, sell target $51.50, and stop loss at $43.50.
Got it. And one more.
Yep, JD.com, ticker JED, one of the big Chinese e-commerce players. Might be a play on consumer trends in China.
And the levels for JD?
Buy near $31.50, sell target at $33, stop loss at $30.
Okay, ARM, ASO, and JD. Examples to look into from the source.
Exactly.
So let's try to wrap this up. To recap our deep dive.
Yeah.
Wow, quite a week. We saw the market bounce back, but it's clearly walking this tightrope, isn't it? Balancing economic data, company results, and all these political factors swirling around.
Definitely a delicate balance. And the big question really hangs over the market. Was this rebound sustainable or just a reaction to short-term news flow? Which brings us right back to that question of the week, posed in the Market Compass source. With CPI and PPI hitting us this week, what do you think? Will that inflation data be soft enough to push the Fed towards cutting rates in September? Or will it keep them firmly on hold?
It's the multi-trillion-dollar question, isn't it?
Pretty much.
And maybe a final thought to leave folks with. In a week like this, you see the market rebound, but there's also so much uncertainty, geopolitical, economic. How much of the market's day-to-day movement is actually driven by the fundamental numbers versus just the power of the story, the narrative, the reaction to the latest headline?
That's a great question to ponder. How do these different forces, the hard data like jobs reports, corporate earnings, versus softer things like presidential tweets or shifting sentiment, how do they interact? How might they pull together or pull apart in the weeks ahead? Something to definitely keep thinking about as you navigate these markets.